Chevron pays 3.9% dividend. Microsoft pays under 1%. Most people would call Chevron the better dividend play. Its own earnings history, though, says otherwise. I've been investing in dividend stocks for over 30 years, and yield alone still doesn't tell you if the company can keep paying it, or if that dividend even fits your life. And here's what I mean by fits. My son is 28 and I'm 57. When he mentions the stock that he's looking at, I might think, okay, that's not a bad company, but that doesn't mean that it fits me or my portfolio. In this video, I'm not giving stock picks or ranking companies. I'm using a handful of well-known names as case studies to show you what to actually look at, not what to buy. He's got a different time horizon. He's got a different ability to recover from the volatility. He's at a different stage of life. At 27, I didn't invest the same way that I do now. Back then, I could lean more into the growth. I had time. If the market dropped, I had years of contributions and decades of compounding ahead of me. At 57, I still want growth. But I also think more about protection, income, taxes, and how long it would take to recover from a major mistake. I saw this during the 2008 and 2009 financial crisis. There were people getting close to retirement who were still investing like they had 30 years to recover. When the market fell, the problem wasn't that they had just lost money. It was when they lost it. A 30-year-old and a 60-year-old can both see a portfolio drop, but it doesn't affect them the same way. That's why dividend investing has to start with the investor, not with the stock. For this video, I'm using free value line reports from the Dow 30. I like these because they put a lot of information on one page. Price history, earnings, dividends, cash flow, dividend yield, PE ratio, financial strength, safety, and commentary. If they're good enough for Warren Buffett, I'm sure they're going to work just fine for us. And they're free to download. I'll put the link in the description. Click the PDF option and you'll have the exact page that we're using here. Now, there's a downside. These reports are snapshots. They're not live market data. So if you're evaluating any company for yourself, you'll still want to check the current price, current dividend yield, recent earnings, recent dividend announcements, and any current news. Once you know what you're looking for, yield growth rate, payout ratio, debt, you can also hand it to an AI research tool and ask it to pull the picture together for you. But for learning how to evaluate, these pages are useful. The companies I'm going to use are Coca-Cola, McDonald's, Home Depot, Chevron, Microsoft, and Nvidia. 6 Dow companies, 6 different dividend profiles. Now, let's start with dividend yield. On these value line sheets, Chevron shows a dividend yield of 3.9%. Home Depot is 3%. Coca-Cola is 2.8%. McDonald's, 2.7%. Microsoft is 0.9%. And Nvidia is 0.5%. If all you did was sort by yield, Chevron would jump to the top and Nvidia would look like, well, it was nothing. But that's not the analysis. That's just sorting a list. Dividend yield tells you the dividend compared with the current stock price. That's useful, but it doesn't tell you why the yield is high, whether the dividend is safe, or whether the business is growing. Sometimes the yield is high because the company is healthy and returning cash to the shareholders. Sometimes the yield is high because the stock price has dropped and investors are worried. Those are very different situations. So the first lesson is simple. Don't stop at the yield. After yield, the next question I want to ask is dividend growth. Not just did the dividend rise for the company last year. I want to see the pattern. On the value line sheets, there's a section that shows annual rates of change. That lets us compare how dividends have grown over different periods. For example, over the last 10 years, Home Depot's dividend growth rate is listed at 16.5%. Microsoft is 11%. Nvidia, 13%. McDonald's is 7.5%. Coca-Cola, 4.5%. Chevron, also 4.5%. Now, let's look at the past 5 years. Home Depot is 11.5%. Microsoft, 10%. McDonald's, 8%. Chevron is 6%. Coke, 4%. Nvidia, 14%. That tells us something, and it's important. Some companies have been growing dividends from a mature base. Some are growing from a very small dividend. And some may have grown so fast during a strong business cycle. But that doesn't mean the same rate can continue forever. And this is where people can get fooled. A company that raises a tiny dividend from 1 penny to 25 cents may show a massive percentage increase. And that's real growth. But it may still not provide much income. On the other hand, a company that already pays a larger dividend may only raise it 4, 5, 6%, but that increase may be more meaningful in actual dollars. So I don't just ask, how fast did the dividend grow? I ask, what was the starting point? Did earnings grow too? Did cash flow grow too? Is the payout ratio still reasonable? And could the company keep raising the dividend if the business got tougher? That's where dividend growth becomes much more than a number. Now, there's one more thing I want to point out from these growth rates. Look for whether dividend growth is speeding up, slowing down, or just staying healthy. Home Depot's 10-year dividend growth rate is 16.5%, but the 5-year rate is 11.5%. It's still strong, but it's slower than the 10-year number. Microsoft is similar. Its 10-year dividend growth rate is 11%, and the 5-year rate is 10%. Still solid, but not accelerating. Coke is slower and steadier, 4.5% over 10 years and 4% over 5 years. McDonald's is 7.5% over 10 years and 8% over 5 years. So that one's held up a little bit stronger too. Chevron is 4.5% over 10 years and 6% over 5 years. But with Chevron, you have to remember, earnings move with the energy prices. And Nvidia is the one where percentages can really fool you, because the dividend started from a very small base. So when the viewer sees the dividend growth rate, I want them asking, is that growth durable, or was it helped by a certain cycle, a low starting point, or a temporary tailwind? Now, we need to talk about debt and payout ratio. This is where dividend safety starts to get, more real. The payout ratio tells you how much of the company's earnings are being paid out as dividends. If a company earns $2 per share and pays $1 in dividends, well, that's a 50% payout ratio. But I don't want the viewer to memorize one magic number, because there isn't one. A 65% payout ratio for a very predictable company can mean something different from a 65% payout ratio for a cyclical company. And debt matters because dividends compete with other needs. A company has to invest in its business. That's pretty obvious. It may have to pay interest. It may need to pay down their debt. It may need to buy back its stock. It may have to make acquisitions. The dividend is important, but it's not the only claim on cash. And that's why I like to look at three things together: earnings, cash flow, debt. For example, Microsoft has a low dividend yield, but it also has a low payout burden compared to its earnings and cash flow. Well, that gives it flexibility. Nvidia pays a very small dividend compared to its earnings. Even if earnings got hit, the dividend itself may not be the hard part to fund. The bigger risk may be the stock price, expectations, and volatility. Now, Chevron is different. The yield is higher and the balance sheet is strong, but earnings can swing quite a bit with oil prices. When earnings fall, the payout ratio can look much tighter. Home Depot is different again. It has been a strong dividend grower, but it also carries meaningful debt and depends on consumer and housing activity. If a recession hit hard enough, the question may not be, will they pay the dividend? The question may be, can they keep raising it at the same pace? And that is the educational point. Dividend safety is not one number. It's a relationship between the dividend, earnings, cash flow, debt, and the business cycle. Let's see what the relationship actually looks like in practice, starting with Coca-Cola. This is the kind of company many people think of when they think of dividend investing. Mature business, global brand, long dividend history, lots of cash flow. On the value line page, Coke's dividend yield is 2.8%. Its safety rating is 1. Financial strength is A+. Earnings predictability is 100. That predictability matters. Coke's payout ratio is higher than a company like Microsoft or Nvidia, but that doesn't automatically make it bad. A higher payout can be more manageable when the business is stable and cash flow is dependable. The annual rate section also helps put Coke into context. The dividend growth rate is not the fastest in the group, but it is more modest. But the earnings predictability is extremely high, and that's the trade-off. From the value line page, Coke's projected payout ratio is in the mid 60% range for 2026 and 2027. And that's not low. But because the business is so predictable, an investor may view that differently than the payout that is the same ratio with a company with unstable earnings. With Coke, the question is not, can this turn into a fast-growing tech company? That's not the job that this case study is showing. The question is, can this company keep producing cash, raise the dividend at a reasonable pace, and hold up better than more cyclical businesses when the economy gets rough? But with a mature company, valuation matters a lot, and that's something that I talk about in class. Coke may slowly increase in value over time, but during any given year, it may have a high and a low. One person buys near the low, another person buys near the high. 6 months later, the first person says, well, this is a good investment. Second person says, well, this stock sucks. Same company, different price, different results. That's why I don't just ask, is this a good company? I ask, is this a good company at this price for this investor with this goal? McDonald's is another mature dividend company, but it's not the same as Coke. On the value line page, McDonald's yield is 2.7%. Safety is 1, financial strength is A++. Earnings predictability is 85. The dividend has grown steadily, but the business model is what I want viewers to notice. McDonald's dividend growth has been stronger than Coke's over the longer period shown here on the sheet. Now, that doesn't automatically make it better. It means we need to ask why. McDonald's isn't just selling hamburgers. A big part of the story is brand strength, the real estate, franchising, global scale, and operating efficiency. That business model helps generate cash, and cash is what pays dividends. But there are still things that we need to watch. Labor costs matter, food costs matter, consumer value matters. If customers feel prices have gotten too high, traffic can become an issue. Debt and capital structure, they matter also. McDonald's also gives us a good payout ratio lesson. The value line page shows the payout ratio moving around the high 50s range in the near-term estimates. Now that's lower than Coke, but it's still meaningful. The company still has room, and it can keep growing the earnings to keep raising the dividend comfortably. So with McDonald's, the lesson is this. Don't just look at the dividend. Look at the machine that produces the cash behind the dividend. Home Depot is a good example of why you have to understand what drives the business. On the value line page, Home Depot's dividend yield is 3%. Safety is 1, financial strength is A+. Earnings predictability is 90. That looks strong. But Home Depot is tied to housing, remodeling, mortgage rates, contractor demand, and consumer confidence. If interest rates are high and people aren't moving, home improvement spending can slow. If consumers are stretched, big renovation projects may get delayed. And that doesn't make Home Depot a bad company. It just means the dividend investor needs to understand the cycle. Now, this is where I want to go a little bit deeper. Home Depot's past dividend growth has been strong. The value line page shows a 10-year dividend growth rate of 16.5% and a 5-year rate of 11.5%. Those are strong numbers. But the next question is, could that rate continue if there were a recession? And that's a different question than, is Home Depot a good company? During the 2008 and 2009 financial crisis, Home Depot was hit by a housing downturn. Sales and profits came under pressure. The company did not have the same environment it had during the stronger housing cycles. And if you look at Home Depot's own dividend history, the quarterly dividend was held at 22.5 cents for every quarter of 2008 and every quarter of 2009. It wasn't cut, but it also was not being raised aggressively during that period. In 2010, the quarterly dividend moved up slightly to 23.625 cents. That's the kind of detail that teaches you something, and that's an important distinction. A dividend cut is one thing. A dividend freeze or a smaller increase is another. For a younger investor, reinvesting dividends, a pause may not be the end of the world. But for someone counting on rising income every year, it may feel very different. So with Home Depot, I would ask, what happens to earnings if housing slows? What happens if mortgage rates stay high? Could management still raise the dividend at a double-digit pace? Or would dividend growth slow until the cycle improves? I'd also look at the dividend, the payout ratio, and their debt. The Value Line page shows Home Depot's payout ratio around the low 60% range in the near-term estimates. Now, that's not extreme, but it's not tiny either, and Home Depot carries meaningful debt. Now, that doesn't automatically make it dangerous, but it means the company has more than one use for that cash. So the question becomes, if earnings slow down, does the company still have enough room to invest in the business, service the debt, and raise the dividend? That's a better question than, has the dividend grown fast enough in the past? That's how you evaluate a cyclical dividend grower. You don't just admire the past growth rate, you ask what kind of conditions made that growth possible. And this is where comparison helps. Home Depot's yield is close to Coke and McDonald's, but the business risk is different. Coke sells beverages every day around the world. Home Depot depends more on housing activity and large ticket spending. Same general yield range, different business question. Chevron gives us a different kind of dividend case study. On the Value Line page, Chevron's dividend yield is 3.9%, the highest in the group. Safety is 1, financial strength is A++, very strong. But earnings predictability is only 10. That contrast is the whole lesson here. The company may be financially strong, but earnings can move around because oil and gas prices move around too. Most people understand this because they see the gas prices. One year gas is high at the pump, another year is kind of lower. Those price changes affect energy companies. Chevron's dividend may appeal to someone looking for more current income, but the investor has to ask different questions. What happens if oil prices fall? How strong is the balance sheet? Can the company keep funding the dividend through a weaker energy cycle? Is management disciplined with capital spending? A higher yield is not automatically better. Sometimes it just means you're being paid to accept a different kind of risk. The payout ratio makes this clear. On the Value Line page, Chevron's payout ratio was high in 2025 because earnings were lower. The estimates show it improving as earnings recover, but that's exactly the point. In an energy company, payout coverage can look very different depending on where oil and gas prices are. Chevron's debt level and financial strength help. The page shows A++ financial strength and relatively low leverage for a company that's this size. But strong financial strength doesn't remove the cycle. It helps the company handle the cycle. But this is exactly why I like comparing Chevron to Home Depot. Both can be strong companies. Both can pay dividends. But the risk drivers are different. Home Depot is more tied to housing and consumer spending. Chevron is more tied to energy prices, production, and capital discipline. So if someone asks which one has the better yield, well, that's too small of a question. The better question is, what type of risk am I taking to get that yield? That question looks completely different once you move away from yield entirely, which is where Microsoft comes in. On the Value Line page, Microsoft's dividend yield is only 0.9%. If you're only chasing income today, that may not look too interesting, but look deeper. Safety is 1. Financial strength is A++. That's pretty strong. Earnings predictability is 95. Also pretty strong. The dividend is growing, and earnings are expected to grow too. Microsoft's 10-year dividend growth on the sheet is 11%, and the 5-year rate is 10%. That is very different from a company that simply pays a large dividend but barely grows. Microsoft's payout ratio is also much lower than the mature dividend names. The Value Line page shows all dividends to net profit around the low 20% range in the near-term estimates. That gives the company room to keep reinvesting, spend on AI and cloud infrastructure, buy back stock, and still raise the dividend. But that flexibility doesn't mean price doesn't matter. A wonderful company can still be a frustrating investment if someone pays too much. And this is where a younger investor may see the world differently than someone who needs income right now. At age 28 or 32, the question may not be, how much income does this give me today? The question may be, can this company grow earnings, cash flow, and dividends over the next 20 or 30 years? Microsoft is a good case study because the dividend's low, but the business generates a lot of cash. It has software, cloud, subscriptions, and now major AI-related spending. Now, it doesn't mean valuation doesn't matter. It does. When investors love a business, they may pay a high price for it. And if you overpay, even a great company can test your patience. So Microsoft teaches us this. A low-yield stock can still belong in a dividend growth discussion, especially for someone with time. Nvidia is the most different case study in this group. On the value line page, Nvidia's yield is 0.5%. Safety is 3. Financial strength is A+. Stock price stability is 20. Earnings predictability is 45. The dividend grew dramatically after the increase, but the yield is still small, and that's an important lesson. If a company pays a tiny dividend and then raises it by a large percentage, the growth rate can still look large. But that doesn't mean it suddenly became an income stock. The value line sheet shows Nvidia's estimated dividend growth rate from 2023 to 2025 to 2029 to 2031 at 92%. That number jumps off the page. But the reason it jumps off the page is because the dividend started from almost nothing. That's why percentages need context. If a company pays a nominal dividend, it may be able to keep raising it even if earnings slow, because the dividend is such a slow part of the total cash flow. But that doesn't mean the stock itself is low risk. The dividend may be easy to support while the stock price is still highly volatile. The payout ratio here is almost not even the main issue. Value Line's near-term numbers show Nvidia paying out only a small portion of profits as dividends. So if I were evaluating Nvidia as a dividend case study, I would not spend most of my time asking, can they afford the dividend? I would ask, is this really a dividend stock for my purpose? Or is this a growth stock that happens to pay a small dividend? Nvidia is still mainly a growth story. The questions here are different. Can earnings growth continue? Are expectations too high? How volatile could the stock be? How much competition could come in? How dependent is the business on AI spending? For a younger investor with higher risk tolerance, Nvidia may be interesting to study. For someone needing steady income today, it may not fit. Again, that doesn't make it good or bad. It means fit matters. If I showed you 6 value line pages at once, most people would get lost. That's just too many numbers. So when I compare companies, I like to compare one thing at a time. And earnings predictability is a good example. Chevron has the highest yield in this group, but the lowest earnings predictability on the sheet. Coke has a lower yield, but the highest predictability of the bunch. Now, that doesn't automatically make one better than the other. It just tells you that they are not the same kind of dividend story, and that's the point. There's another question I always like to ask when I look at my own portfolio. Am I becoming too concentrated? Not just in one stock, but in one sector, or in sectors that overlap. Microsoft and Nvidia are different companies. And if someone owns other technology or AI-related stocks, adding another tech-related stock may increase concentration even if the companies aren't identical. The same idea applies in other areas too. You might own companies in different industries, but they may all be sensitive to interest rates, consumer spending, or commodity prices. So don't only ask, do I like this company? Ask, what happens to my whole portfolio if several companies I own are exposed to the same risk? That question becomes more important as you get older and have less time to recover from a big mistake. One more thing younger investors need to understand early is account location. In my dividend reinvestment video, I talked about drips and how powerful dividend reinvestment can be, and I believe that because I lived it. But there's a tax reality. If you're reinvesting dividends in a taxable brokerage account, those dividends may be taxable each year. Reinvestment doesn't mean untaxed. And when I started investing in 1995, Roth IRAs didn't exist. Roth IRAs started in 1998, and the original contribution limit was $2,000. Looking back, there were positions where I think, man, if I had some of that compounding going on in a Roth IRA, my tax outcome would be a lot different. That's not a regret as much of a lesson for myself. The account wrapper matters. Taxable account, Roth IRA, traditional IRA, they can all change the long-term result. For a younger investor, learning that early can make a huge difference. Now, in this video, I'm focused on fundamentals: earnings, cash flow, dividends, payout, the valuation, business quality, and whether the stock fits the investor. There's another side of the discussion, and that's technical analysis. Some investors use charts to help think about timing and after they've studied the fundamentals, and that's a different kind of analysis. For today, the point is this: fundamentals help you understand the business. Valuation helps you understand the price. Technicals may help some people think about the timing, but don't use a chart to excuse a business that you don't understand. So here's where I want to leave you. Dividend investing is not just looking for the highest yield. Chevron has the highest yield in this group, but it comes with commodity cycle questions. Coke and McDonald's are more mature dividend companies, but valuation and growth still matter. Home Depot is strong, but housing and consumer cycles matter. Microsoft has a low yield, but strong cash flow and dividend growth. Nvidia pays a dividend, but is still mainly a growth and volatility story. Different companies raise different questions, and different investors can reasonably reach different conclusions. At 28, my son can look at a company one way. At 57, I may look at it another way. That doesn't mean either one of us is wrong. It means our goals are different. So don't ask only, what's the best dividend stock? Ask, what am I trying to accomplish? Can this company support and grow the dividend? What risks come with this business? What price am I willing to pay? And does this actually fit my life? That's how you move from chasing yield to evaluating dividend stock. If this video helped you today, great. That's what we're here for. And we'll see you in the next video.